Okay, you can take it. Thank you so much. I have it now. Okay, Arinze, you can take it back. Okay, bye-bye. I'll connect through YouTube. Bye-bye.
Thank you very much, sir.
Okay.
Okay. Okay. It's 6:59. Safe to say we are ready to kick off today's webinar. Welcome everyone once again to today's webinar. Today we have Michael Olafusi with us. He's CEO at Your Biz Edge. Yeah, you could reach him out via LinkedIn. He's going to be taking us today on building financial models for your business. Over to you, Mr. Michael. Good evening. We are very happy to have you on Tekedia Live today.
Hi, Arinze. It's like you are on mute. I didn't catch the last sentence.
Oh, I said over to you, Mr. Michael.
Oh, okay.
It's a pleasure having
right.
you on Tekedia Live today.
Oh, okay. Thanks a lot, and good afternoon. It's evening, maybe afternoon for some people. So good evening, good afternoon, and maybe good morning to some people also. And I'm going to try to share my screen so that we can get started. I'm sure some people have questions. So instead of doing another elaborate talk and introduction, I'll go straight to sharing my screen. So I'm going to share the entire screen. Let's look for that particular option because that's what is going to work. I'm going to share the entire screen. This is strange. It's like there's no more share entire screen. Okay. Wow. Okay, so I'm going to just share this then. Maybe as I go on, I'll share the other ones, but share the entire screen will have made it perfect sense. Okay. So again, good day, everybody. My name is Michael Olafusi, as we've all as I've been introduced. I am an advanced financial modeler, also a chartered stockbroker, also a member of the Institute of Stockbroking in UK too. I have an MBA. The MVP stands for Microsoft Most Valuable Professional. So because I use Excel, Power BI heavily, and they gave me that award for like 6 years running now. I am the lead consultant and co-founder for Your Business Edge, Your Biz Edge Limited. I also am a financial analyst fellow for Brightmore Capital. So I do their financial analysis due diligence. The companies they want to invest in, I run their financials, I build their model, come up with the pricing, the valuation, so they can know how to counter the offer or the bid of others and the price the company is trying to sell itself as. I also work for TopTal. TopTal is a US firm that is into consulting for Fortune 500 companies, and I do financial modeling and valuation for them. So different clients through them anyway. Then build financial models, investment models, valuation models for companies in UK, Canada, Zambia, Nigeria, Mali, and Cote d'Ivoire. There's still one or two other companies that I've not put in here, but that's not the whole point. So I want to quickly throw a question to the house. Please, I'm going to try and use two screens so that I can see your questions I can see your answers as I ask questions. So I'm going to be monitoring the chat box. Okay, so I want to ask you, let me reshare my screen so that you see the question I've created, what I'm going to use to, so new share. Going to stop sharing, pick another one. Okay. So I'm going to show some questions right now, and I need you to answer the questions. So I'm going to put up, okay. I hope you can see my screen.
Yes, we can.
Great. All right. So I want you to answer these questions. I'm going to zoom. So question number one, let's start with question number one. Have you gone through the lecture videos? And the pattern you should answer it as is question number one, yes. Then question number two is, do you have a company of your own? I need you to type the answers into the chat box. I'm monitoring the chat box via another of my screen or another of my laptop. So please type in the answers. Okay. Right. So, all right, I'm already seeing. Do you have a company of your own? Again, it's a yes or no. Question number three is, have you gone through the, there is an attached template. There are two templates. Have you gone through the templates? The financial modeling templates or financial model templates. That way I will not be starting with wrong assumptions. Okay, so again, yes or no. Maybe I should, you mentioned that you can connect with me on LinkedIn. So that's, let me just quickly paste that in here. Okay. All right, so let's see what your answers are. For question number one, I can see a lot of yes, 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 yes. So that's good news. Some, okay, a few no's, but mostly yes. So I'm going to work with, I will try and see how I combine because again, we want everybody to get value from that. But I'm happy that most of you have gone through the video lectures. Okay, then question number two, I see a lot of, let's see. Yes, I think it's a split between yes and no, yes and no. So some of you have your companies. Sole trader, yeah, you also have your company, yeah. Okay, so let's say that is a split, yes, no, yes, no. Then number three, oh, awesome. Some people have gone through the template. That is really good. Okay, so in that case, I can put in question number four. Since I'm monitoring, it will guide me. So what are your expectations for this live class so that I don't keep repeating what you've already have? What are your expectations for this live session? What are the problem parts that you would like me to so this one is not a yes or no answer I'm expecting. I'm expecting you to write out, what your expectations are, so that way, as I'm talking, I will be monitoring and I can be able to, align whatever I'm saying to at least capture as many of your expectations as possible. Okay. So great. I'm quickly going to do a recap for those of you who have not watched the video, and then it will be a slightly faster recap than what I have already in the lectures, right? So you've seen all the questions. I want to take away the questions so that we can go straight. I'm hoping to see answers. I'm yet to see any answer for question 4. So please type in what your expectations are. Please, Arinze, is my voice clear? Sometimes I have an issue with this mic, so sometimes it shows as cracking. I want you to confirm that it's not cracking so that
Yes, it is very clear.
It's very clear. Awesome. All right. So please write your expectations. I'm going to take away the questions from the screen because I need to go straight into the slides. Okay, I can see it's coming in. So I'm going to share. I just wish, I don't know, it looks a bit funny. This is like the first time I'm seeing that my Zoom is not going to let me share the entire screen. It's just letting me pick a section of my, okay, well, it is what it is. So I go back to this one, and luckily I'm monitoring another. Okay, great. So I've done this. Now, what's a financial model? Okay, so what is a financial model? A financial model is, as you can see here, a financial model is used to represent a company in its entirety. Nobody goes into business, well, if you are in this mini-MBA, I don't think you're into business for play. It's not for play, it's for serious things. Some of us, this is the only thing we do. Like for me, my business is the only thing I do. So it's not for play, right? You are in it to grow your efforts and money and all of that. So financial model encapsulates all what the business is doing in terms of its financials. And you know what? If an investor is going to invest in your business, the investor is in US, is in UK, you can send them their financial model. That's what I do. I'm currently in Nigeria. The PE firm that I work with as a financial analyst fellow, their HQ is in Senegal, right? They even cover Francophone West Africa. So they don't even cover companies in Nigeria, right? And the partners, the sources of funds come from people investing from Europe and maybe US too, right? And you know what? The operations in Senegal for the in-house team, me, that I'm part of the analysis fellow, I'm in Nigeria. The companies they're investing are in Mali, in Cote d'Ivoire, in Senegal, in different countries, right? And yet, I can be able to give them a true picture and say, this company is doing well. No, this company is not doing well in these aspects, right? And how am I able to do that? It's because we force them to give us their financial statements. And then from there, I create a financial model. And then we use that to understand what the state of the business is compared to the industry, compared to what is possible, and also what the prospects are. Then there are some other teams that do their own due diligence, fact-finding, legal, and some other things. But ultimately, whatever they do is meant to remove shadows so that you don't buy a business that looks fine in the numbers, but there are some things happening back end that are going to scatter those numbers. So, but the financial model is very key because it boils down to the figure. What is this business worth? What are we going to put in? And when we put that money, how much are we going to ask for in terms of equity? So here I have two definitions that I think you will, I think this is Investopedia, not Wikipedia. Sorry about that, this is Investopedia. Wikipedia is not that reputable anymore because anybody can go there and fill in something. So anyway, financial models are used to estimate the valuation of a business or to compare businesses to their peers in the industry. Then from Corporate Finance Institute, financial modeling is important for many different reasons, mostly related to making decisions around mergers and acquisition, raising capital, planning, managing a business, and making investment decisions. And as you can see here, there is a company that I've shown here, and this is what the financial model captures. If you have any questions, please dump them in the chat box. I'm going to be monitoring and answering your questions. I don't want us to wait till the end. Okay, so I'm reading through what some of you said. Can we extrapolate for sensitivity analysis, especially, let me just start from beginning. Okay, so David Adejumo says, how to build scenario case and start from scratch, also to know factors to consider when building a model for a consultancy firm. Unfortunately, we cannot start from scratch. The good thing is there are many videos online. You can even Google, there are some videos by me that you can use. I have a course that is on starting from scratch, and I tell you that even though the course assumes that your Excel is good, it takes nothing less than 7 hours of you watching. Then practicing alone itself takes another like 20 hours. So nobody has ever finished that course in 1 week. Well, except for one person who it was just one particular thing he wanted. So imagine I do that in 1 hour. I won't be able to build from scratch, but I will point you to resources you can use. No specific expectations, but an opportunity to discover something unique that will arise dynamically between colleagues. Okay, great. Nathaniel says build financial projections. Yeah, that I can work out for us within this. How to arrive at equity valuation of a new company. Yeah. How to extrapolate for sensitivity analysis. Yes, that is also already built into the template. So if you can always modify it. To be able to understand and appraise financial statements and value a company, that's what the template does for us. So yes, good understanding of financial model and its implementation in business. Awesome. That's the real plan I have actually in this session. Okay. So that's by Osaweze Obuye. Buki says better understanding of financial models and the best one to use for an SME. So anyway, it looks like all of you have watched, most of you have watched this video, so I won't really say too much about this. The financial model has the three parts, definitely capturing how the company utilizes. So one, capturing how the company utilizes its resources. Two, the cash availability. Three, revenue and expenses, right? So as a business, you have houses, you have computers, you have equipment. Those are your resources. How you utilize them, then maybe you borrow money, all of that. You want to make most out of it, right? And then the money you have to, because actually sales and expenses in real business are never always exactly cash. You can sell something and the person is owing you money. You have it as sales, but you don't have the cash. So the model also track that part. And then the revenue and the expenses. So you can see, are you even on paper making profit, right? Is your business running profitably, all right? So you will notice that all those things I've said, they equate the different sections of the financial model, at least financial statements for a start. There's the balance sheet, which tracks completely all of your resources and the debts, because actually debts too are money that you have marshaled to use to grow your company. So if you go and borrow money and you're not using it to grow the business, that's a very terrible thing. Then the cash availability is tracked by cash flow statement. Then your revenue and expenses is tracked by the income statement. So you see how every financial statement is always into these three folds on the minimum. So that gives clarity to that. I move on. If you have any question, please ask. I'm monitoring the chat box. So this is a very high level view of the connections between everything. It's only going to be someone who has some bit of experience with financial modeling, with finance, the financial concept, that maybe this might not be overwhelming on, but I will try to at least explain. I've mentioned that there are three parts, right? So there's the income statement, there's the balance sheet, and then there's the cash flow statement, right? So you see the income statement, which is in red, keeps track of your revenue, your operating expenditure, other revenue and expenses. If you earn interest on cash, and if you pay debt also too, it tracks that. Then once it tracks that, those are the things that it tracks. Then it tracks some aspect of your capital expenditure, which we have to bring in as depreciation anyway. Okay, so you find out that also your taxation, the tax you pay, and these are the things that the income statement tracks. These ones that have, so these are like 1, 1, 1, 1, 1, 1, which is an income statement. Now, if you go to the balance sheet, actually balance sheet tracks everything. So everything ends up leading back somehow to the balance sheet. But then let's follow this diagram to at least understand where you're going to grab the whole thing from. Obviously, you see the blue lines, right? So 2, right? You also see here too the blue line, 2, these, and if you follow these, right? So you see that the balance sheet tries to capture the money, debtors, the creditors, and to be sincere, is everything it captures anyway, because if you look at the lines further, you find out that everything again fits back themselves, okay? So I'm going to go to the cash flow statement. The cash flow statement in green, right? So if you look at it, 3, and 3. So changes in other equity, even changes in debt, and whatever you spend on fixed asset, capital expenditure captures it, interest captures it, other expenses, it captures it. Then definitely money you get from other people, it captures it. Money, and then money people owe you, it captures it. And it also tries to reflect what is in your opening. So again, like I mentioned, this is too high level for us to try to make clear to everybody. I just want you to understand that this can always be a framework. So whenever you're looking it takes a bit of time as you keep working through the templates. It might look like a bit overwhelming. You come to this diagram, you begin to understand how everything is linked together, right? Okay, so let's see any question. Okay. A little more emphasis on company valuation. I have always felt that audit protocols can take a variety of positions, and financial reporting based on the audit is often promotional document to support commercial position of the company. We want to communicate such as a report to AGM. Okay, I'm guessing you're asking what is how seriously should one take the financial model? I'm guessing that's what you mean, John. You say you've always felt the audit protocols can take a variety of production positions. Okay, then looking forward to understanding financial models for potential investment for my startup. Would like to cover the probing skills in due diligence. Okay, so with this now, I'm going to stop and continue with this. So the usefulness of valuation, as you all by now are familiar with, is the fact that we want to understand what the value of the business is, right? So financial models, in addition to showing us what is happening right there in the business, becomes a bedrock for valuing the company, right? So you find out that if you decide to value a company using cost approach, so right now I'm going to flip to the screen that I can write from, okay? So I have like multiple screens. Okay, so I'm going to flip to the one that I can write from. Okay, so we have cost approach, which allows us to, you use this a lot for asset-heavy industries. So when I'm doing financial models for oil and gas companies, for real estate companies, they always want to also have the cost approach taken. Okay, so asset-heavy companies that basically are selling their assets, kind of. An oil company is selling the reserve assets it has, extracting the oil and selling. The real estate or malls is actually the physical property they have that they are making the most of. Okay, so there's a limited contribution of what we call the human part and the intangibles, kind of. Okay, so they always like to have a cost approach. So there's a depreciated replacement cost. There are so many popular ones. If you call an estate valuer, someone who values as a company, values properties, usually they use this depreciated replacement cost, DRC. So how much will it take to replace what is there? Then if you are valuing a company using the market approach, which is other comparable companies where they are selling out, you're looking at the stock exchange, you're looking at people who have bought similar companies, then great, use the market approach. For market approach, you will just be picking figures from the financial model. The financial model has a limited use here in terms of you'll be picking ratios. We call them ratios. So it could be like the company selling at enterprise value, to sales of maybe 2 times. So if I know your revenue, which is sales, then I can value what your enterprise value is. This one also uses the financial model completely, because that's where you're going. It uses more the balance sheet side, the what the company has as asset. So it uses also the financial model, but more the balance sheet side, Whereas this one usually focuses more on the income statement side. So what's your value? The valuation of the company could be like maybe 4 times profit, 6 times EBITDA. You hear all of those kind of terms. And then this one, the DCF, uses the entirety of the financial model. There's no way you can do a DCF valuation without you doing the financial model entirely the way. If you see the template I've given you, it ends up with the DCF, because the moment you've done the financial model and forecast, then you have pretty much everything to complete the DCF. So you will notice that the one I gave you has the DCF, okay? All right, so with that said, I've already told you to send me your questions. So let's go and look at what I've given us, and then any questions you have. So I'm going to move into one of the, I'm going to share the new screen as template now. Okay. Since you have the template too, you can open along if you are able to, right? So the way you use this template is this. Right here is a summary sheet to show the important metrics about the business, right? Okay. Then here is the table of content to make it easy for you to navigate, to say, I want to jump to one section to the other section. And then here is the model input sheet. So this is where most of your work, you will notice this is colored in yellow and this is also colored in yellow. So the concept is that you should I've done something. You should, the ones colored in yellow are the ones that you are meant to put in your assumptions, your inputs, your parameters in. You shouldn't touch the ones colored in blue. Those ones are automated. Clear? Okay, great. So now let's go into the actual inputs themselves. Okay. So if you run a business, I will have asked somebody to give us an example, but because of time, I'm looking at the time. I don't want us to derail ourselves too much. Since you've watched the videos and you can always watch the videos, I want us to tackle the problem points you have and the common things you will have to face. So if I'm using this right now, so what I'll be doing is my business, I'm going to start putting the product I make. I make this product. I make this product. So if I do not make up to 4 products, you can wipe off the 4th one and say, yeah, this does not apply to me, right? If you make 4 products, awesome. If you make more than 4, you can add more, okay? And then if you have questions, please put them in the chat box. I'm monitoring the chat box. The unit economics. So what is the unit volume you want to push out for different years? And then the unit price you're going to sell at, the unit cost to produce that particular product. And then you put all of that. So that's what this one captures. Your product, the price and the cost, right? The volume you're going to push out. And this is pretty much straightforward. Your expenses, right? So it's just that I can't show you real client work. But the truth is, even clients that, foreign clients that I'm charging in dollars, right? This is similar. This is the template I use. There might just be a bit of line differences. Like there's a company that what they are into, they are not going to be incurring lease or rentals. So I will just knock off the things that do not apply to them, put the things that apply to them. And so this is not an half-baked template I'm giving you. I'm giving you pretty much, the only thing you are not having is maybe me and holding you on how to build it from scratch. And that's why I'm trying to focus more on how you can use it. Then if you know how to use it, you can always work backwards, fill in the gap of the finance knowledge you do not have. If you're already an ICANN, if you're an accountant, you will not have problem. You can always, the only thing that will be left is just tracing the Excel formulas. Okay, so this captures the general and admin expenses. And then this captures the marketing expenses broken down into the common categories. So we all know what advertising, public relations, you do trade fair, you do event sponsorship. Any other one that doesn't fall into that bucket, you put them here. Then R&D, so if your company incurs R&D, you put them here. The tax rate, so currently Nigerian corporate income tax rate is 30. Some people prefer to use 32. They want to capture the ETF, the education tax. Okay, so if you take any loan from any bank or person, you put them here, it might be a person. You know, I've had to do a model for a company, the PE firm I work for was trying to invest in, and the lady who owns the business borrowed money from her uncle that lives out of the continent. And, you know, we put it there, loan 1 from Uncle ABC, right? So it doesn't have to be a bank loan. Sometimes you can borrow I've seen companies that they borrowed their company money, you know, like I'm a founder, after I've set up the business, right? There were particular months that we could not make payroll. I had to take from my own money and pay the staff. And I'm not willing to capture it as equity because I want to get my money back. So it will come here as loan. The only thing is, am I going to give it to the company as an interest rate or not? That's where the difference of treatment applies. You have all of the latitude in choosing whether you want to make it interest-free, so that you just, when the company bounces back, you take your money back. And then there are sometimes when some people, they come into some wealth that they decided to just sell off that property so they can fund the business, but they don't want to put it in as equity. They want to take their money back. So that one can spill into multiple years. Whereas the one I said about salary can end up forming into like you are doing a kind of a bank overdraft to your business. So that one within a year might not end up showing as a multi-year loan. So it's the multi-year loans that will come in here anyway. And then the loans, any questions, please just keep piling them up there. And I hope you can see my screen clearly. Okay. So the loan 1, loan 2, I gave 3 spaces for loans. All right. And then bank overdraft. So this one is, you will never know ahead. The only thing you will know is if you have an overdraft facility, a credit arrangement with a bank or a credit provider, they will always tell you what the rate is. So if I'm able to draw up to say 2 million naira, you know, at any point from a bank, right? And at 15%. So anytime there's a shortfall in my working capital, you know, maybe I'm unable to pay a supplier, or because of timing difference between when money comes and when money goes out, I'm out of cash, I can draw on that credit facility, almost like how some of us get this private credit card. It's almost similar, you know. The fact that they don't tell you that they're borrowing you a million naira, you're just saying you can draw up to X amount of money, you know, to satisfy whatever you need to cater for until your salary comes, or in this case, until some money comes back and then they remove, you know, whatever it is you owe them. So you want to put in that effective rate here. If you don't have, awesome, just put 0 there. You know, cash interest rate. So if you make it a rule to put your excess cash in an interest-bearing account, so some people put them in fixed deposits or some kind of, apart from your normal bank, your normal operating bank account, you know, that may not even have interest, that in fact is even incurring bank charges and maintenance fee. Sometimes you want to pack in excess cash into maybe treasury bills or some kind of investment. Like for my own business, we put ours in a money market fund. So that way, like during this corona, it helped us a bit. It helped us not a bit, a lot. There were months that it was that money we had to draw to satisfy current needs, to meet up with operating costs, salaries, and the rest. So if not for corona, I probably would not have drawn on it. So you want to also capture the interest that comes on it there. Then equity. So you want to put in, you know, what did you guys start the business with? So we started the business with 100 million naira as equity. You know, if you have questions, you can always post in the chat box. Please mute yourself if you are, so that you don't distract others. Let me see if there's a place I can mute everybody. I don't know if I have that control. Mute others.
I've done that, sir.
Okay, great, thanks. All right, so then common shares equity. So typically, you want to issue common shares because it's less restrictive. But I've had cases that people would rather put their money as a preference shares. The thing is this, preference shares, that's why the name preference comes before the shares, has some bit of protection. So like the PE firm I work with, sometimes they want to invest, say, X amount of dollars in a business, but they want to gain both the upside in terms of equity and gain the protection that comes with you borrowing as a debt. So it's a cross between equity and debt to some extent. So we are like, okay, we're going to put in this money, but not as ordinary common shares, but as preference shares. So we're going to be getting like a fixed income payment, you know, like if it was a loan now, we are borrowing you money at 10%, we borrow you 100 million naira, then that means every year in total you will give us 10 million naira interest, and then you pay the principal. So in this case, we are like, okay, we are going to make sure you commit to a dividend, preference share dividend yield. So you're going to be paying us, say, 5% of your earnings after, like, profit anyway. So your net earnings. So that's what makes it a bit superior to, it ties the business to committing to paying some percentage. So they're able to get a bit of protection. They're getting some of their money back. Every time the company is profitable, they get a bit of their money back, and or they still keep the equity side of it, like they are still shareholders. Okay. And some even try to put convertible clause also, so that we can convert it to loans. You know, the moment we feel this thing is also this business is no longer looking as great as we thought. So but anyway, until they convert it to loan, this is where it will be. If they convert it to loan, then that particular year you will then take it out and move it to loans. Okay. But it's not really common. It's not that very common, you know, that at least so far with what I've encountered, people would just rather put it as preference, as equity, because it creates a lot of ambiguity. It makes it difficult for other investors to come in when they see that clause. And so they too know that if they are going to get other investors, they would rather not scare them away. All right, so capital expenditure, what you're going to buy regarding different classes of assets that you need to run your business. So if you need to have a building, if you don't need to have a building, then awesome, zero. If you must buy a building, then put the value there. Then plant and machinery, or what you need, vehicles. So typically assets that have similar years of usefulness. So buildings usually 35 years. There's a variation. Just make sure whatever you pick is in line with the normal in the industry, in our space anyway. Then plant and machinery, depending on the type of plant, many plants 15, some are 10, some are, so you know the type of plants you're buying, and then you can always search easily from the manufacturer's documentation, from online, what is the typical average lifespan of that plant, and then you put it here. Vehicles is usually 4 or 5. If it's vehicles that are not used for marketing, 5 is the much more sensible number of years people put. But if it's going to be used for marketing, which means it's going to be used really intensively, some people put 4, some people put 3. Then office furniture. So you get the whole pattern, right? So you put in IT equipment like laptop, printer, and some of those IT equipment, most of the time like 4 years. But what I'm saying is you can always change this. If you think this is 4 years for you, just come here and put 4 years. Everything here you can change. And if some companies do salvage value, which means they don't depreciate it to the end. They know that they can always sell it off at the end for some change, for some money. So like vehicles, they could put like the salvage value is 200,000. So every time the depreciation factors in the fact that this thing is not going to be depreciated completely to 0. So if you know that is the thing that applies to you, that's what you fill in those values in here. Then you see these working capital days, right? So we all know that in business, there will be different classes of customers, and there will be different peculiarities depending on the nature of your business. No matter how big your business is, it's very uncommon that you can force everybody to pay you cash up front. You sell and they pay you exactly. Even the supermarkets that we go to, that we always feel like they will not let you walk out of the supermarket unless you pay, right? Some supermarkets also run delivery, that they have some kind of contract with some companies to always deliver some of their office supplies. And those companies, they might be like, you know what, we cannot be paying you every single day. We only make payment on one particular day of the month. So anything you've delivered up until that moment, that day of the month, just make sure you submit your invoice and they pay you. So which means there will be days that they've made the sales to that company that they have not yet collected the cash. So it's just for you to look at it. In my own business, on average, how many days does it take me to collect my cash? If you don't know and you've been operating already, you can always check what is your revenue that you have already for the period you've been operating. Then check how much people owe you. Owe you is receivables. So how many of it you've not gotten? And then there's a formula. This DSO is simply equal to that receivables over revenue times 365 or 60. Let's just say 365 days in a year. And so from there, you will know, okay, it takes me 10 days to collect my revenue. It takes me 11 days. But if I've not been operating the business before now, it's just for you to estimate, okay, realistically, how long will it take me to get money? It's an average figure. Some people always pay you on time. Some people, it's usually a weighted average. If you have a lot more of your customers taking 20 days, net 30, that's why sometimes you have all these terms on the invoice, net 15, net 30, though some people don't pay attention to it anyway. So you use the realistic figure here because that is going to forecast your receivable. Similarly for payable, are you able to squeeze your suppliers and negotiate with them that I'm not going to pay exactly upfront, that I'm going to pay, and it's always something you want to do. Apart from the fact that in proper account management, right? Okay, I'm reading through some of the questions. The depreciation. Okay, John is maybe trying to address the question by Akim or something. Okay, so the days payable is, I was saying that in proper account money, as a business, you want to even make it a plan that you're going to negotiate with your suppliers and let them allow you to be able to collect goods on credit. And do we call it on credit, but like allow you to be able to pay them after some time. And the other thing is, the more structured you are, the less you want to be paying. Most companies like to have a particular day that they pay everybody. If you've noticed that, you see a lot of companies, if you deal with big companies, you see they always tell you this is the last day to submit your invoice for anything that you've done for us this month. Your payment will be processed and you will get your payment on next number or on a particular date. Yeah, because it doesn't make sense for them to be paying people especially when there are thousands of transactions. It's better they collect it and then they pay it at once rather than paying every single invoice all the time. So the bigger you go, the more you'll find out that you just have to always owe your suppliers, and the more you can negotiate the length, the better for you, because that means you will have some cash with you. At least the timing difference, you must owe your suppliers, if possible, longer than your own customers owe you, so that way you will not end up like how most of our family members do. They go to Dubai, they go to Saudi Arabia, they go to some other places, buy jewelry, clothes and stuff. Those ones, we not let them leave unless they pay. So their payable outstanding is zero. They pay before they go. Then they come to Nigeria, we buy from them, we sell until salary comes. Now they've sold everything. They sold it for profit. Maybe they bought at 1 naira, they sold at 2 naira, double, right? But they don't have any money. They can't go and restock. Why? All their money are outside, right? So credit crunch or cash crunch, their working capital management skills, not that good. Then days inventory outstanding, how many days do you hold your inventory, right? So if you run a drop shipping kind of business, a business where you are focusing on logistics rather than having a warehouse, then this will be really low because there's a cost to holding inventory. So you want to understand the nature of your business. If I'm running an online business, where is when you order that I source for it, and then in that case, my inventory, I will probably only have zero inventory. But then there are some businesses you cannot do that. You always need to have it in stock to sell, right? So then it's just for you to always check again. If you know what your cost of goods sold is, and you know what is in your inventory, yeah, you can always calculate it too. If you are already existing, you can always or observe what is happening for your business and use that as a guide to forecasting into the future. So this is how many days you hold inventory. Do I always have, if I'm a car dealer, does each car, most people know it. If you're into business, you will know. You will know how many days it takes you to sell your product. Some people know that, okay, even though you have for different products, if I'm a car dealer, I will know that maybe it takes me 1 month to sell a car. So what do I do? How many months inventory do I want to hold? Do I always want to have 3 cars, which means 3 months inventory, so that I will know I don't need to restock for the next 3 months, right? So it's like that. People know that. People who even run restaurants even know it. That's how they will know how much to cook, so that the food does not spill over to the next day, right? So it's if you're in business, you will just know it. It's now you putting it into the model. And then if you have other current assets, other current liabilities, again, anything that doesn't fall into this anyway. Sometimes if you know your business is really straightforward, you can put 0 there. That there is nothing that you don't have biological assets or have things that are not falling directly into these other ones. Okay, so you see, I spent a lot of time here because this is where your work is going to lie. Once you fill this correctly, and then this one, every other thing works on that. So all other sheets is just for me to tell you what they capture, but this is where your own work really, really lies. For those of you who are saying, how do you build this? In fact, the work of building lies here. The fact that you will now be using formulas to link up to what the person has typed in here. Okay, so it's like reverse. The user's work lies in here. I'm hearing myself echoing. Okay, I hope it's not like someone has on his speaker. So the user's
Arinze,
work.
Yes,
sorry,
yes, sir.
excuse me, faculty. Arinze, you may need to mute everyone on mute. There is a background noise somewhere. Sorry. Are you there, Arinze?
Everybody's muted. I think maybe he's using two devices. Everybody's muted.
Okay,
This is
okay,
great.
because I can hear
So,
background noise from YouTube side. All right, sorry about that.
yeah, so I was saying that it's kind of like a reverse. You as the user, right? Your focus is more on these two sheets in yellow. Whereas for someone who wants to build this again, like reverse engineer, the good thing is I left the formula. So those of you who are interested, you can always rebuild it. But the focus of this session is not to show you how to rebuild it. Because like I said, that will be a disservice to those who are not even financially inclined. Even when we do this for companies, we don't, the focus is to make it easy for them to use. That's why they want someone to build it for them, and then they can use it on an ongoing basis. Okay, so that's what exactly I have done here. I've made it very easy for you to use, and I'm explaining how you are going to use it. So yeah, because your payroll, your expense on salary and all of that is very significant. It doesn't make sense to just lump it as one line in here. It makes no sense in reality to just have it as one line bundled up together. So we want to give a lot more clarity to how that figure is going to come up. So you want it to be easier. So I want it to be easier for you to be able to say, okay, we are going to have X number of directors. Typically, your chairman usually directors are not always on the same level. If you have a chairman, you typically pay him more than what you pay the other directors. So there might be more than one category of directors. Okay, and it might be a case of maybe because of the status of that person, you just have to pay him something that makes sense, even if he's not the chairman. So anyway, that's why I have two categories here. So if there's someone you're paying 1.5 every year, typically not so much because you are paying them just for as it's a bit more like honorarium to some extent, appreciation of their time, and you still have to cover their flight and all of that. And also, but it's usually not as significant as what you end up paying the CEO anyway. Then all the different people you will hire, So this is something that is easy for you to feel. If yours are more than this, just keep adding them. I need to hire X, Y, Z. I'm going to need like 6 of them. And then for the first year that we're hiring them, this is how much you are paying as salary. And then you will notice that if you want to keep increasing the salary, if you want to have it that, okay, the salary will keep going up, say maybe 10% year on year, then it's always easy just to add 10% to all of this. So this is the first year. That's why I made it obvious that this is the first year. If you feel that you can hold that salary for as long as possible, great. If you feel it needs to be increased, then you can always increase them the way you want. So I gave you full flexibility, and all of this adds up to capture what will be the staff cost and what will be the director fees. So these two lines you are seeing here. Okay, so these are the places that you need to worry yourself about. Okay, so I'm looking at questions. There's been a lot of background noise since the start. There's really kindly, wow, sorry about that. Oh, okay. John says he was not answering Akin. Okay, I'm going to just try and I'm just wanting to be sure that I don't miss out on any important question. So if I have not answered your question, please don't be annoyed. I want to make sure that I manage the time well too. But I'm monitoring your questions, right? And thank you, Ian Acho, for saying the financial modeling class is something you find really valuable. So thanks for that. All right, now that you should be comfortable with how you make this to align with your own business, right? Let's now go to what is in here. So these different sheets, some of you have been asking, how do I run different scenarios? So what about the scenario analysis? There is a scenario analysis in Excel, right? But that scenario analysis is not dynamic enough for financial model. In financial model, you want to do something that is very, very dynamic, something that you can see there's a scenario manager, but it's very static. If you change the figures, you need to rerun it. And that is too complex for users. You cannot be telling the MD, most of the times the people who use the financial models are really people at the very busy, the management people. As much as you can automate things, the better. So that's the approach usually used in financial models. We have a dedicated scenario sheet where we are building it from scratch. The other one that you do, that you might use the scenario. Yeah, someone wants to say something.
Mr. Michael, yeah, sorry to cut you. I must note that this session wouldn't have any stretch. We'll be ending this session at 7:59. So please, if you have your questions, kindly use the raise hand feature or send your questions to the chat. Mr. Michael has been taking questions and is still taking questions.
Thank you.
Please ask your questions already because there won't be a stretch for this session.
Right. So this is how you are meant to use these different scenarios, right? you'll see here that you can pick any 3 scenarios. It's become like a standard practice to let people have 3 scenarios preset into the model, right? And okay, so I'm monitoring also the questions. Thanks, Arinze, for that announcement. So now this is it. The conservative comes directly from what you have put in here. So whatsoever you've put in, because we feel that when you are being realistic, you've done your due diligence, your market research, you've done all those other things we covered in the whole Tekedia MBA, your strategy, you've mixed everything together to decide that this is what is feasible based on the capacity of the factory, your resources you have, the strategy you're operating, the customer fit, and all those strategy, they lead you up to putting the figures you have here. So these figures are well thought out. They are like your best, your most realistic approach. Like, that's why we call it conservative, something that you can reasonably defend. You know that this is what, with all of the efforts you're putting in and the reality of the market and what is happening right now, this is what you can achieve. So that flows directly into the conservative. Okay, you can see comes from the model input. So what if things go really better, which happens in life, right? This COVID that we're complaining about, for some people, it was an optimistic kind of effect it had on them. You know, things became better for them. They were able to push out more volumes. Okay, I have some clients in the healthcare industry. While we were complaining of no job, they were being overworked because their industry was booming. Similarly for some online businesses, right? So you want to be able to see that your model is able to, this is you capturing like a range of values, like stress testing it, saying, okay, this is a really big deal. I want to have like a range of, if you've heard of people saying Monte Carlo simulation, this is like a very reduced, manual version of it, where you want to see across the range of possible outcomes, just like here across 3 outcomes. So that means we call this a kind of triangular kind of a distribution, where there is a worst case, there is a best case, and then there is like a middle case that has a higher chance of happening. Anyway, I don't want to go into the technicality, but the practical aspect is this: you can always change this. If you feel for you optimistic is 1.4 times, just put it there. If you feel for you the conservative is 0. The business is able to achieve 70% of the volume projected, just put it there. And as you put it there, it's going to flow directly. There are formulas that are going to fit, pick them up, right? So that's how this one works. Put in the volumes for the different scenarios if you feel the ones I've put do not align with your own reality. And so this captures all of your product lines, but it bundles together all of your expenses, right? Because again, even though you've been very meticulous with how you came up with the expenses here, the reality is we all know inflation can happen, things can happen that are outside of your control. So you want to also say, what if we spend more than what we envisage? What if we're able to cut down on some costs? Because the more you operate, the better, the more efficient, you're able to become more streamlined, you're able to find better suppliers, you're able to become more cost lean. So you find out that there can be an optimistic case where you even achieve less cost than what you envisaged. So that captures that. And then the marketing expense, similar to, you might find a better way of marketing, leveraging maybe people sharing your viral marketing and things that will cut down on the actual cost of marketing for you. And then you capture that. And what if, you have to really, you find out that your values are not achieving the figures you want, you need to bump up your marketing expense. So all of that is what scenarios capture in here. Okay. Then from there, instantly, you will see the revenue schedule that shows all of the revenue from your different product lines, and boom. So this one is very straightforward. Okay. These are really good in terms of review. If you need to, if an investor, or like I said, I work for a PE firm that we are physically apart. If I send them these, there is no ambiguity. They see everything. They can go, if they have concerns about the revenue, if you look at the income, usually what they start from is they look at the summary. What is the valuation coming to? What is the money they want to put in? And then they now jump usually to income statement. And then they look at the figures. If they feel this revenue looks really absurdly high, then they can go to the revenue sheet and look at, okay, what's even the breakdown? So that's usually how people go about using it. Okay, so, but then I'm walking you through, this is also the cost of sales, how the costs, direct cost of the different products are
Okay, is there
coming
any
up.
other question? I think Mr. Michael
Okay.
has.
Yes. Okay.
Yeah,
Yeah.
Mr. Michael has done justice to almost every question so far. Yeah, the question on the chat, what's the difference between preference shares
Between and common
and
shares.
common
Okay,
shares?
great.
There's going to be a due diligence session coming up, so
Okay, so I should let that
it
part.
doesn't
That
necessarily have to
okay.
single value.
Okay. Okay. All right. So for the working capital lines, I can see someone saying I will get to the sensitivity analysis, right? Okay, so for the working capital, again, like I mentioned to you in the model input, all what you put in here as how many days it takes you to collect your money, how many days it takes you to pay your suppliers, how many days you hold inventory, all of that feed into the working capital. So all those days help us to estimate how much of our money will be showing in receivable, how much of our money is going to be showing in payable, how much of our money is going to be tied up in inventory, how much of our money is going to be tied up in all of this. So again, this is for visibility for whoever is reviewing to be able to see, okay, how come inventory is this high? It comes here and it checks, oh, they expect that they're going to hold 10 days inventory. Oh, that does not make sense. Our other competitions, they're able to achieve 4 days, let's change it. So depreciation, again, all of what you plug in there in the input as regards how many years the different asset classes are depreciated by, the salvage value, right? All of that build up to get for us what the total depreciation is and then what the net book value is. So after you take out the depreciation, you get the net book value. So this one shows clarity to that. Then debt, this is the part that if for those who want to reverse engineer, this is where you will sweat the most. So anyway, this one captures what happens as for cash that if you're going to be any interest on them, put them in interest-bearing account, cash plus that, bank overdraft or revolver that you have, how much, if you need to draw on it, if there's a particular year that your cash is not enough to cover your working capital needs, then it will instantly draw and instantly pay whenever the money has come. Though it's like a kind of cash sweep effect, but here there's no explicit cash sweep. It's just to quickly pay up as soon as you have made back the money. Then the loans. So again, all of these ones you are not to touch because as you plug in the values in here, that's why it's called a model. This will pick them automatically. So this is just to show visibility. If a banker wants to see how you are modeling the debt that they're going to give you and other debts that you are collecting from other people, they will want to see it on this sheet and see it and say, okay, all right, we can see that you can comfortably capture all these things look reasonable. Okay, so similarly too for equity. So someone who was asking difference between ordinary and preference share, I think I mentioned it in the beginning, but like we said, because of time, I might not be able to reiterate, but I'll just say that ordinary shares has no exceptional clause to it. It's just, you partake in the growth, you partake in the downside, no special condition. Preference shares usually have a commitment of a dividend payout. So in the setting up of the preference share, there will be terms that could be like, I bought into First Inland Bank preference share in 2006. And the condition was that they were going to pay us 7% of net profits as dividend. So ordinary shareholders have nothing of that kind of advantage. But for us, they told us upfront. But the problem is also they gave us clause of how we can convert our preference shares to ordinary shares. So it has a bit more complexity than the ordinary shares. Then dividend, you all know. So anytime you put in the place here, if you are putting that there are going to be dividend payouts at any particular period, then that one flows directly into here, and boom, you will see the calculation and ultimately calculates the retained earnings. Then lastly, tax. So tax again is very straightforward a bit because our tax, usually company tax are very like a flat rate. It's not like employee tax where it's graduated, right? So that makes things a lot easier. The only thing here is just that if your business has not been in operation, you will have an idea around the difference between your accessible tax and the thing you actually pay, your accounting tax and the one government tax. So that's what we call this. So again, to be sincere, if you're starting your business, you can never know that. So you will always just have it this way. But if you have started your business, you'll be understanding that maybe there's always like a 10% difference between when you finally do your auditing and they assess your tax, maybe it's always 10% more than what your accounting is. You capture that difference there, and that will flow into your deferred income tax. Again, it's a bit high level because I'm focusing more on you using it. I'm just explaining what you are seeing here. The income statement is very straightforward. And what I've done is I've helped us to add some ratios that you will find useful. So operating income, so I've added those ratios so that you don't have to go between different sheets to see what's important to you. You can use that ratio to compare yourself with the industry average. Am I performing? Is my assumptions too optimistic? If you are going into competing with Nestle and you don't have all the advantages they have and power over suppliers they have, and your own gross margin is more than their own, there's a problem. So this helps you to do a check, reality check. Then balance sheet is also straightforward. The very different assets you have, and then for you, you won't have to fiddle with anything. It's me in building this. So it's only if you have messed with something that this will no longer balance out. Okay. Then cash flow, similar to, it should help you to see how are you getting cash from operations. If you're not getting cash from operations, that's a very bad sign. It means you are operationally loss making, which makes no sense. Investing, yes, that one is normal for it to be negative for a growing business because you'll be spending more, rather than selling your assets. Then financing, depending on whether you are trying to get more equity or pay off debtors, that one can be, up or down. Okay, so the DCF evaluation, so the person who has been asking sensitivity analysis again and again and again, this is where we typically do it for the DCF evaluation. The one for the model is usually the normal scenarios. For the DCF evaluation, you now can say, okay, what if 10% WACC, 12% WACC, and then you put in all of that range, and then maybe up to 18% WACC. What if we're able to do a long-term growth of 1%, 2%, and then you pull. I'm ending in about 4 minutes time now, and then you put that in here again. It's because the person, a lot of people asked it. That's why I'm just doing this. Then you calculate what the effect is. The good thing is all these things I'm doing, you should be able to go, and I'll give you a resource. So maybe I should just do that now. If you go on, we have a free course on my platform. So if you go there, you can do the free financial modeling course if you are part of those who is interested in okay, great. So you can see there are some free courses. Unfortunately, you can't see my screen. I'm grabbing the link and I'm sharing. So I'm putting the link directly now. So you can go there, take the free course. You might be lucky that what is in there is enough for you to carry on without having to pay for any resource. So thank you very much. Let me just see if I have missed out any question. So Alaka Hakim is saying that the design financial model is compact and comprehensive. Thank you. The funny thing, I have these also in another platform, and I've been getting people call me from outside of Nigeria, US, India, majorly. And they've been like, awesome. Like, I was amazed that, okay, maybe, like you said, it fits a lot of people's requirement for comprehensive one. You promised to share some. Okay, yeah. So that course link I've said, yeah, you can get free courses there. Yes. What other thing? Sensitivity analysis. Yes, this is. I select it and I go to condition, what if analysis, data table. I don't know if you can see my screen clearly. Data table, and instantly I will plug in. There's something that will come up on my screen. Let me just put that in. So I'll plug in that row input cell. What I have on the row is WACC. Is the growth. Like I said, it's better you just go through the course so it doesn't look like you're just following me blindly. And then this will compute what the company will be worth. Currently, it's not computing correctly because there's a circular reference I need to make to calculate. But instantly, it will compute for you what the company valuation is. Okay, so any other questions? Let me just turn on the condition.
Any other questions? Because it's 8:03. Okay, in the absence of further questions, we really want to say thank you very much, Mr. Michael, for making us, so much content available to us in just 1 hour. Thank you very much, sir, for today's session. We really learned a lot. And thank you everyone who made out time to attend to this webinar on YouTube
And like
Live.
I said, you can always,
yes.
If you contact me on LinkedIn, I've posted my LinkedIn contacts. You can always reach out to me. I'm very not good with replying on time, but I always reply. So thank you very, very much.
Yeah, thank you very much. Thank you very much, everyone. Have a great night. Thank you.
Yeah, bye.
Good night, everyone.
Thank you. Even though I don't really understand on business or anything. Thank you.
Thank you, Michael.